intro, but very short because these guys are legends. They have pioneered DeFi. Stani, founder of Aave, Santiago, partner at Parafy before, now starting Inversion. And you guys are actually quite close. If I recall correctly, back in the day, 2018, Santiago was knocking on Stani's door to invest in Aave with Parafy. It turned out to be an amazing investment. So, yeah, it's great to have you here. Thank you for coming.
And I remember because Santiago actually was from TradFi and was doing investment banking and whatnot, and we met in SF, and I think back then when you were in Parafy, a really small fund at that point at a WeWork that has grown like so significantly as the whole space has been growing.
Yeah, I mean, Aave was probably our best investment. Kind of a fund returner at the time. I think it was still called Lend, and everyone was like, DeFi wasn't even a term, but Maker had survived, and you guys were live, and I think Compound had just raised a round, and it wasn't even live, and it was like an order of magnitude higher on the valuation for us. It was like, okay, clearly this is working, and it was a team of what you were a team of 20. You had retained really good engineers through the bear market, and for us, it was a clear signal of, okay, that there's definitely something here in the space.
Hmm.
So we've come a long way since, I guess.
And now we've grown DeFi to 148 billion in TVL. RWA is still a lot smaller, we're at 24 billion. But Stani, I saw you tweeting recently that the DeFi growth in 2021 seemed similar to you as the RWA growth we're seeing today. And of course, with Aave, you want to tap into that, specifically with Horizon. How do you think about that? Which kind of assets do you want to use as collateral? For example, the OpenAI tokenized stocks or SpaceX. Do you see that being used as collateral down the road?
Yeah, I mean it's definitely. I think there's like a three main kind of like a points of what I think is the future of finance, and obviously DeFi is the main thing in the sense that DeFi is all about financial opportunities and creating best financial opportunities in the most transparent environment, and DeFi is in a place where whatever value we can tokenize and bring on chain that can be distributed across globally, borderless, in a fair and efficient way. And the other piece of the whole puzzle is RWA. So when we started Eatland back in the days and building Aave, so we always had in our minds that we built Aave in a way that we're utilizing the native crypto assets. But there's so much value outside of the whole native crypto ecosystem that could run agnostically on this technology. And we tried to build it agnostically in our minds that you can use it for native crypto assets, but down the line also for these traditional assets. So RWAs was another part of the kind of like a triangle. So DeFi and RWAs is about looking for the value that already exists in the traditional world and bringing that on chain. And we need RWAs for DeFi to scale because these crypto native assets have their own limitations in terms of scaling at the moment. And it's natural transition because you're basically moving from one financial substrate to another. So in the very early days, tens of thousands of years, we started as a financial ledger using clayboards. We transitioned to paper and then to digital a few decades ago. And every single medium actually creates new types of properties. So what was amazing about digital is that every single person who participated in the markets could access the same information at the same time and trade globally. And that reduced the inefficiencies and improved pricings. And now we're moving towards very early, as we know, for the size of the RWA markets, moving to a new type of a substrate. And this medium is about bringing more security, resiliency, and transparency. So RWAs are to create more value and to create more financial opportunity that DeFi can distribute. And then the third of kind of a corner of this triangle is stablecoins. So stablecoins have been seen as a instrument of bringing stability in the countries, for example, Argentina, where there's a high inflation, but not hasn't got that much attention in the past in the Western world, where we basically have a really good banking system, really good rails. But where stablecoins can actually provide a really good value is to access DeFi, because that's the only way you can get into DeFi, consume and create these interest rate markets, and also you can extract the yield out of DeFi and distribute it through traditional means, traditional distribution channels, for example, through fintechs, institutions, and so forth. So these three components are what I think is the future of finance and what we are focusing with Aave. And obviously, DeFi has grown significantly. It's still a drop in the ocean. Stablecoins are getting now more traction, and there's more regulatory certainty around stablecoins. And I think there's stablecoin issuers from big tech, commerce, and fintechs that are looking into the space. So there's a lot that is going to happen there. And now the last kind of component is the RWAs. And tokenization is really interesting, but actually what makes these RWAs interesting is the collateralization aspect and how you can use that in DeFi.
Mm-hmm, mm-hmm. And on the stablecoin side specifically, so what we've seen historically is that we've seen a massive increase in stablecoins. Today it's about 250 billion in supply. And mostly the demand for these RWAs came from stablecoins. People didn't have yield, so they bought treasuries with the stablecoins. Something I've been pondering in the last couple of months is, how do we move beyond that? How do we move beyond just this kind of ceiling of stablecoins? Even if stablecoins grow to 1 trillion, 2 trillion, it's still limited versus the 500 trillion in assets out there. Do you have a take on that, Santiago?
Yeah, well, definitely, I agree with your point. Like stablecoins are like the first instantiation of a real world asset, so to speak. It's like there's a physical thing and is represented digitally. So like stepping back, like RWAs, I think is a pretty bad term, but we'll run with it. What does it provide? Because from our standpoint, so for context, right now I'm very focused on acquiring traditional businesses and making them more efficient with crypto rails. That doesn't mean that the end customer sees the crypto part, but it means that there are very specific like line items in the P&L that you can streamline, cut costs, or increase top line, because we're working within the constraints of a current financial system that predates the internet. So far so good. But when I go talk to RWA protocols, a lot of it is, okay, what else are you focused on beyond stablecoins? And a lot of it, to your point, is credit. So most of it is tokenizing treasuries. That is mostly catering to a crypto native audience that wants to diversify their portfolio, right? If you're all in on crypto, at some point you want to compose a portfolio that is probably safer on the risk curve. So you go and buy tokenized treasuries. If you're a foundation, you want to clip some yield, and that's okay. Look, at the end of the day, like most of the world still doesn't have access to pretty basic financial products. Like if you're not a high net worth individual, if you're not in a European country, if you're not in the US, you can't really, invest in these products. And so that in and of itself, I think is a massive market, right? So that brings, new liquidity. Yesterday we saw Robinhood, for instance, announce tokenized stocks, tokenize like private securities like, OpenAI and whatnot. So like, I think like it's important to like go back to the early days of DeFi and say, okay, what is it that tokenizing an asset actually improves?
Mm-hmm.
I think a lot of it is access to people that haven't had access before. Some of that is crypto native audience. Other parts are just non-crypto native audiences, where I actually think that's where the most of the opportunity is. Like a company like Robinhood or a bank in India or whatnot, like could access and offer these services to the user base. I think there's going to be a lot of demand coming on chain, and you're going to tap into some of the core DeFi primitives. Um, but so the access, the transparency, like the composability. When I describe DeFi to my friends at JP Morgan, still, it's never about how traditionally you go about it, but you say, imagine a financial system that is very transparent. You can inspect the bank and assess collateral ratios, solvency ratios, covenants in real time. And their eyes light up. They're like, oh, that'll be amazing. You're like, yeah, it's called DeFi. And they're like, oh, no, we don't touch crypto. Like, no, we don't like that. But that's, I think, the fundamental promise. Now, I want to address just the last point, which is how do we actually expand this pie beyond credit? As much as tokenized treasuries are all the rage, in a world where rates go to zero, if and when we get there, what else can we get there? So we talk about tokenized stocks. We actually see a big opportunity in creating long duration paper and crypto. So if we go do a leverage buyout of a company and we're going to put 2 turns of debt, we think there's an opportunity to emit debt natively on chain, right? Why? Because you can express in the smart contract fairly simply, it's SOFR plus 600 or whatever. There's a market clearing rate. You might be able to get lower cost of capital on chain, actually. Like, you remember, Stunny, there was a time right after like the FTX collapse, like rates in DeFi, borrowing on Aave is actually cheaper than borrowing from your bank. And I think the integrations with the real world, like if you want to go buy a house or do other stuff, it's actually quite useful, right? So that's where we see a big opportunity for us. We're think of us as a private equity fund acquiring businesses. We can tap into capital markets on chain to issue debt or issue some sort of security, and all we're trying to solve for is it the lowest cost of capital. So because I think one of the issues we've had historically in crypto is this like adverse selection problem, which is if you have exhausted all of the resources in the real world, you come on on chain if you're an issuer to tap into the capital markets, right? And so historically that's been sort of the issue for some projects, right?
And how do you want to address that adverse selection problem?
Well, we're only going to buy companies that we think are quality.
Mm.
So you'll very easily be able to say, listen, this is a retail company that, this is a historical financials, it's a solid business, you bring it on chain, you issue debt against that. And why would we do that? Again, it's cost of capital. There's a wider audience perhaps. And so I think that's I think where we graduate from this just being a very niche market, only tokenized treasuries, to can we create more robust capital markets on chain, because I think that's really where the vast opportunity is, like emitting debt. And these are, we're in the business of like making returns for our investors. So like we want to acquire businesses that I think are worthy to, emit debt, and that's a quality asset.
Mm-hmm.
Limu Limo at your service. Here to help you save hundreds by customizing your car insurance with Liberty Mutual.
And from our perspective, obviously Aave has now kind of reached a lot of momentum in DeFi, and currently is the most trusted protocol. There's 43 billion worth of deposits, and it's a very stablecoin driven model. And now with the Horizon, which is a Aave initiative, we want to use the same technology we've been used before, but into RWA. So Horizon is essentially a Aave market where you can use permissioned assets as a collateral to borrow stable coins. And this is kind of interesting what actually Santiago said, that how important credit actually is to grow DeFi in the first place. But also to get more of these RWAs into on-chain, because the tokenization is it's just a tool and one step getting the asset into this new environment. And then you need to have utility and collateralization, and being able to manage collateral more efficiently over the weekends, have more flexibility, better terms, and smart contract-based execution can go a really long way there. And I do agree that being able to extend debt and credit is going to be vital here. So we're going to start with more of assets that are lower on the risk curve. That's basically treasuries, money market funds, and then moving forward also up on the risk curve, credit funds, and also down also on the volatility as well. So ideally, you should see Horizon as a market or initiative where you can actually collateralize almost your whole portfolio. And the idea of this market, how it's differentiated, is that there's a lot of liquidity at the moment for these traditional assets that exist on chain. So you can't basically liquidate the same way as you typically would these native on-chain assets. So it's a little bit of a customized market. And then with the Aave v4, which we recently introduced, the idea is to actually allow them to create different types of risk profiles without segregating the liquidity, and being able to actually categorize different RWAs on the risk curve, and then create different kinds of liquidity pools where you can allocate into these risk pools and borrow against. So I think anyone who is thinking about RWAs today, one of the key challenges is to think about the consumption and who is the actual audience and the user. And I think a lot of the answers lies in decentralized finance, and also the benefits that DeFi can actually bring. That's why it's really important to have a really solidified DeFi strategy as well.
And I think over the years, we've seen a clear shift in the interest from banks. You mentioned it, JP Morgan, once they heard DeFi, they were pretty scared. Now, you tweeted recently, Stani, that you attended the Goldman Sachs Blockchain Summit and you saw extreme interest in DeFi from TradFi. Like, what kind of initiatives do you think these banks will start, and what kind of products can they offer to the clients, which is powered by DeFi?
Yeah, I think the way they think about is, they want to use Aave in terms of as an infrastructure. So taking what Aave is today, a very robust and safe protocol architecture, and taking that and using to traditional assets and being able to use that as for collaterals. And I think that's the right way to think about it, because all this technology that we build, it's still technology. So it should be suitable to different types of use cases. So RWA is a really big thing in tokenization. And I think the Robinhood announcement was also really interesting, because you start to seeing companies that have very solidified distribution, so they can actually flip the switch and move their whole environment into token-based or tokenized environment, and plug in DeFi really and naturally as a kind of like a next step. So what we will see a lot is actually utilizing DeFi infrastructure into these traditional assets, and building also a little bit more on-chain liquidity. But I think with traditional assets, it doesn't really matter whether the liquidity is in the beginning on-chain or off-chain, because it does exist in some place. So I'm personally excited also about what Santiago said of the access, because the first place why we started Aave and Eatland is to basically democratize finance, to giving everyone the same equal access and opportunity to financial opportunities, and reducing the information asymmetry. And today, we have better access than we had decades ago. We have better ways to make financial decisions. There's AI, LLMs that actually give you the best tools anyone can have around the world, basically. So, and with DeFi infrastructure, you add transparency, you add smart contract-based execution, so you can actually make your system more resilient. If you think about Aave's performance, for example, in the during the news of the tariffs, when the markets were going down, we liquidated over 200 million worth of collateral in just a few minutes across 13 different networks, and that just states the resiliency. And if you go a few years back, we saw a lot of centralized lending businesses starting up, and none of those centralized lending businesses exist today, because they didn't have the same resiliency that, for example, Aave and DeFi has. And I think that's a big statement why you should use DeFi, and why it's actually a really good infrastructure for traditional assets.
Yeah, this is something that we've heard a lot. DeFi in the back, fintech in the front. There's this big debate going on as well. Like, the next big winners, are they going to be crypto adjacent or crypto native? And maybe it depends on where you sit in the stack. Santiago, you're a bit on both sides with inversion. How do you
Yeah,
think about that?
so look, I mean, as much as I love DeFi and the infrastructure has been created, I would take the position that most of the value will be captured by the user aggregator. And so that's the reason why we started Inversion, because we see this opportunity. Again, traditional businesses, you can rip old infra, swap in crypto rails in some way, shape, or form. Now, of course, like if liquidity grows an order or two of magnitude, of course you're going to have, these projects, are very like from an organization standpoint, compare like a Hyperliquid to Binance in terms of headcount, in terms of profitability. Compare Aave to a traditional bank. Compare Uniswap to a traditional exchange. Like crypto crypto projects protocols are vastly more efficient from a per employee basis. They're global day one. So like the profitability of these protocols is quite interesting. So they stand to benefit again, but on a marginal basis, we see a lot of opportunity in taking traditional businesses and making them more efficient. I heard it once, first time founders focus on the product, second time founders focus on distribution. And again, like I think the challenge that we have in crypto today is it's not really relatable piece of technology. So if you go outside and walk in the street, you tell people about stablecoins, they'll just be like just sip up a seed, like walk away, like I don't want to hear about this. The opportunity that we see in crypto is how can we make it invisible for the end user, right? Where it is so natively integrated. Because at the moment the user base of crypto is anywhere from 30 to 60 million actives, no matter how you slice it. And so how do we get that to 1 billion?
Mhm.
And I think it starts by large businesses that have an existing user base, that have a good relationship with the customer, right? And then all of a sudden, they might turn on some functionality where the user, what would the user see, right? They're like, hey, listen, I want to buy a home. Your approval might get cut down from 3 days to 1 day. Your ability to like shop around with different bank providers can be streamlined. The interest rate might be lower. Like these are some of the concrete things that users want. And I think there's a very big opportunity. If you're a bank, if you're an issuer, you'd say, okay, how can I improve my customer experience and actually beat out the competition by tapping into this financial system that is very efficient, that can offer some tangible benefits. Um, so, I think you're already starting to see that. Like Robinhood, for instance, is seeing this opportunity very clearly. You see Vlad talk about he runs two sides of the business. One is traditional brokerage, the other one is crypto. The crypto piece is vastly more efficient, faster growing. Nubank is an example as well. They're the largest fintech in Latin America. They have over 110 million registered users, 80 million active. The number one asset that is bought through the app is USDC. To Stani's point, I mean, there is so much trapped capital. Financial inclusion is practically non-existent in developing countries. And I know the unbanked narrative has been thrown around in crypto since the very, very beginning. But I think it's worth like revisiting in this particular moment in time where we have built incredible infrastructure with Lindy that I think, Stani, I'd be curious your opinion. When you go and talk to a traditional bank, you can point to them. You can say, listen, we liquidated all this in this particular day. We've been around for 10 years.
Mhm.
Very different conversation if you'd gone to them, back in the early days of Ethland, they would have like laughed you out of the room, right?
Yeah, and I think a lot of folks are in the TradFi surprised of the amount of data that is accessible, that you can actually go to DeFi and actually see these protocols and see how much, let's say, net deposits there are, how many liquidations there are, and what kind of like a risk profiling exists. And I think that's the benefit. And what Santiago mentioned about the cost aspect, there is value of getting part of the business on chain to reduce the cost, and also from risk perspective. So if you can actually quantify the whole systemic risk in decentralized finance end to end every single second, you can make better decisions compared to a financial system where you make decisions based on quarterly reports, annual reports, or even for regulators for regulatory filing. So I think in overall, it's just a better execution environment. And I do agree that a level of abstraction needs to happen in the sense that a lot of DeFi is somewhat inaccessible. So in terms of Aave, for example, we have 43 billion worth of net deposits. That's more than, for example, Revolut, SoFi, N26, and a lot of these fintechs. But we don't still have the same accessibility for everyday users. And this is just happening because why? Stablecoins are expanding. A lot of the account management infrastructure is getting more secure, more advanced, and the whole experience can be enhanced in the next couple of years quite a lot to reach that audience. So I think I'm really bullish about this idea of like moving the business on chain, and I would like to see, for example, foreign exchange completely moving on chain and getting better pricing as well. So that's also quite interesting.
Thank you. Final question for you. We didn't see your hands. Same question that I asked the audience. By which year will we hit 1 trillion in RWAs? Just a number.
100 trillion?
1 trillion.
Come on, let's do 100 trillion.
Let's do 100. Okay. So that's about 20% of all global assets.
Yeah, I'm bullish.
Okay.
Yeah.
Which year?
2029.
For 100 trillion. Okay. That's
I mean, we need to work hard. You know, you need to go there and get
like
some assets on chain.
Yeah.
We'll bring the first billion users, and we're not looking to acquire small businesses. So I think it's incumbent upon us as an industry, but I think the opportunity is there. But I think anything I've learned as an anecdote, when we first invested in Lend, it was a sub 10 million market cap project, but it had, it was working. The smart contracts were there. Not even in my wildest upside case did I imagine having how much TVL do you have today?
We have 43 billion net deposits.
How much?
43 billion.
40 billion.
About, yeah.
40 billion. Okay. I think we were on our best case scenario, that would have been, if this gets to 1 billion, this would be amazing. And then it did that. And I think like, it's just important. Crypto sits on top of the distribution of the internet. And so don't be surprised when you graduate the financial rails from a system that predates the internet to a totally digital borderless financial system. There are monumental amounts of money sitting in trapped countries that want to seek yield. And that's just like, I'll leave you with that. I think it happens in the next 5 years for sure.
Okay. Thank you, Stani. Thank you, Santiago.
From sub 10 million market cap project, but it had, it was working. The smart contracts were there. Not even in my wildest upside case did I imagine having how much TVL do you have today?
We have 43 billion net deposits.
How much?
43 billion.
40 billion.
About, yeah.
40 billion. Okay. I think we were on our best case scenario, that would have been, if this gets to 1 billion, this would be amazing. And then it did that. And I think like, it's just important. Crypto sits on top of the distribution of the internet. And so don't be surprised when you graduate the financial rails from a system that predates the internet to a totally digital borderless financial system. There are monumental amounts of money sitting in trapped countries that want to seek yield. And that's just like, I'll leave you with that. I think it happens in the next 5 years for sure.
Okay. Thank you, Stani. Thank you, Santiago.
Thank you.
Welcome, Eva.
Hi, it's a pleasure to be here. Thank you for having me.
Eva, what brings you to the Staking Summit?
So this is my second Staking Summit. I've also been to the Staking Summit in Istanbul, which we remember is where we first met. And I think that these are an important trend for our industry. It's great to bring people together, especially as the industry grows and we see new participants. It's great being here today and seeing that firms that were not previously in Istanbul are here in Dubai talking about staking. Maybe they started a new project. Maybe their firm is now offering staking. I think we've seen an increase in participants in the staking space over the last couple of years. So it was great to be here to speak with peers and friends in the industry and learn about what everyone has planned for the remainder of the year and going forward.
Eva, tell us a little bit about your role, because I mean, we are here in Dubai, and there's no coincidence that you are here.
No coincidence, that's correct. So I am the head of Europe and the Middle East segment, so all of EMEA. We've seen growth here in the region and across Europe over the last 12 months and beyond. And it's a region that we're particularly excited about. I think with the regulators in both Dubai and Abu Dhabi offering crypto firms clear frameworks around starting a business here, building a project, we've seen a lot more institutions and foundations move to the region. We have been working with clients here for a couple of years now, from everyone from a custodian to an asset manager to exchanges. And we see it as a great place for the industry in general. So we're excited to be here. And for me personally, it's a region that I'm very focused on. Europe has been a strong region for a very long time, but I see the Middle East, Dubai in particular, kind of creeping up as an area for a lot of opportunity.
It sounds incredible. What what has been sort of your trajectory here? As was there anything that, because I mean, Figment is the biggest or big staking provider. How is your growth in the region? What has enabled your growth, and who is your main? Is it institutions? Is it a family office? What is your story here?
Oh, good question. So we are the largest independent staking provider. Our story here in the region has actually been centered around partnerships, I would say. So we partner with all of the largest custodians globally. And in the region, we work particularly closely with Tungsten, who are a UAE-based custodian, as well as Zodia, BitGo, um, Fireblocks. And through those partnerships, we have been able to connect with asset managers, family offices, hedge funds, and a lot of other customers here in the region. Um, Generally, what happens is when a firm, and you're correct, institutional is our focus, when a firm thinks about staking, they have to first solve the custody problem. So once they've solved custody, then they think about staking. So once a firm, let's say a hedge fund, has a custodian partner, then staking is the next step, and that's where we come in. So we have had a lot of success working with our custodian partners here in the region. Um, I think that what we're excited for and what we're looking forward to next year will be the growth of more VC firms, more projects, foundations in the region. Um, and I'm hoping that will continue this year. We've seen some exciting projects over the last couple of months, but I would say all eyes are on next year to see how the Middle East grows with that respect.
I understand you also have an exciting new product, so to say, in this context.
Yeah, I wouldn't. Not quite a new product. As I mentioned, we're focused on institutions. So the way we think about staking is if we service the largest institution globally, the most regulated, the one with the largest risk and compliance team, security team. If we fulfill the needs of that institution, then we can also service some of the smaller institutions as well. If we meet the needs of the ones with the most requirements, then we can also service everyone else. And so we have for a long time been working with ETF and ETP providers. And most recently, we announced that we would be the main staking provider for 3IQ and their new ETP products. So that is an exciting announcement for us and is hopefully a sign of more growth in that space. Globally, we've obviously seen growth in the ETP space in Europe. US needs to catch up, but hopefully we'll get clarity from the SEC on that to allow for other institutions and ETP issuers to offer staked ETPs. But we're very excited to announce our partnership with 3IQ. And we're even more excited to see what else this brings for the industry. More products, which include staking as they should, right? And an ETH product, for example, that doesn't include staking, it is not a complete product. So in terms of an area of the industry, I wouldn't say product, but an area of the industry that we are really excited about is definitely the the ETP and the ETF side of the business, and that's actually what our CEO and one of the co-founders, Lorian, just came off stage here at the Staking Summit discussing was the growth of that market in particular.
That's fantastic. I mean, everybody in crypto talks about bringing in institutions and bringing in widening up the space. They talk about abstraction and make it easier for different kind of players. When the fund they talk, and you are actually, from an infrastructure point of view, you are literally onboarding them.
Yes.
Yeah, you're
Yeah.
facilitating the journey, more than facilitating.
Yes, exactly. And hopefully it's a smooth, journey for all the institutions coming into the space, right? Because then they will continue to grow and increase their offerings and their products in the space.
Let's say I'm an institution. I hear this conversation now, and I'm interested. How can I learn more about this, and who do I talk to?
Yes, of course. Well, you can, of course, reach out to me, Eva Lawrence. You can find me on LinkedIn and Twitter _Eva Lawrence, or you can just reach out to Figment via our website, figment.io, and click connect with us to reach the team there. And we also share some great resources on our website. So we have a page with dedicated research, which I would also recommend for any institution or individual interested in staking to take a look at too.
Eva, thank you so much for being here. Thanks for the great conversation. I wish you a successful summit and a good start with this exciting partnership you're having there.
Thank you so much. Thank you.
Okay, so it's been an amazing morning. We've heard from the regulators, we've heard from the banks, we've heard from the stablecoin issuers, we've heard from folks doing tokenization, and now we're going to talk about lending. Crypto and lending is a sensitive topic for a lot of people, but the credit markets are back, and we're going to talk about this cycle and how this cycle has, especially with all the institutional capital, how has lending changed in the crypto markets. And we've got representatives from across the industry to talk about the borrower side, the lender side, the infrastructure side of how this new lending market will work with digital assets. So maybe we start with a quick round of introductions. So if you want to share a bit about yourself, and we'll go on.
Sure. Good afternoon, everyone. I'm very happy to be here today. So my name is Kevin. I'm the co-founder and CEO of Keyrock. Keyrock, we're a global crypto investment firm. So we started actually the company 7 years ago, mainly focusing on market making, so providing liquidity on spot markets and eventually on derivatives market as well. Today we make markets on, I think, around 3,000 markets actually, where we're providing liquidity 24/7. Again, both on spot and derivatives. As it comes to lending, I guess I have kind of two different perspectives. So we're borrowing always, like we're always borrowing to continue to grow our trading activity. So I think I'm seeing the market from that perspective, mainly when it comes to fiat, to stables, and to majors, to the main cryptocurrencies. But we're also actually active as a lender ourselves, but on a very niche market, which is NFT collateralized lending, which is something we're actually one of the main liquidity providers on NFT collateralized loan, which is a bit niche, I'll grant you that, but we're seeing that perspective as well. So yeah, look forward to the discussion today.
Hi, good afternoon. Miles Harrison, Chief Product Officer at Amina Bank. We are a regulated global crypto bank headquartered in Switzerland, regulated by FINMA. We've been operating since 2018. From a lending perspective, we have a range of lending products that cut right across TradFi and crypto.
Hi, everyone. Good afternoon on this sunny day. My name is Anush. I'm the Chief Product Officer at Zodiac Custody. We are a digital asset custodian and infrastructure platform with multiple jurisdictions. From a lending perspective, actually, we have no involvement. Why we are here today, though, is part of the glue or the infrastructure that sits between the lender and the borrower, acting as a tri-party services agent. So very excited to pick into that a little bit more today.
Hi, everyone. Chris Tara. I'm president of Bullish Exchange. So Bullish is an institutionally focused, regulated crypto exchange. We do about $2.8 billion a day in volume.
All right. So maybe just starting with the state of play. What's changed about the lending market in the last 6 months? And could you just give a view of how you see the lending market? Maybe starting with you, Chris.
So At Bullish, we don't have any native lending product. We do a little bit of margin lending. What we do though, we have a 24,000 Bitcoin treasury balance, and so we're constantly looking for dollar borrows. So we're very active in DeFi, but we've looked at, one of the perspectives that we have is we've probably looked at every way possible of sourcing dollar liquidity utilizing our treasury balances. And we're starting to see more and more interest from TradFi lenders, but it's still very expensive. They're still trying to get to grips with using Bitcoin and other crypto assets as collateral. And, this is in spite of the fact that, it's 24/7, 365, pristine collateral, as some people would say, and highly liquid markets. Now what you can do is you can take those assets and you can then sort of securitize them. You can turn them into like IBIT or FBTC or another ETF product. Then it fits more neatly into the sort of preferred streams. And where we are, so we're starting to see a lot more interest from traditional financial institutions, in that space, and the rates are a lot more aggressive. But candidly, where we tend to do a lot of, certainly the shorter term activity that we have is on chain. And why is that? It's because it's cheaper, it's quicker, it's easier, and so on and so forth. So from our perspective, we've definitely seen a lot more institutional players come into the space, but in a lot of instances, they're still trying to get their heads around how exactly to engage with the asset, figuring out the capital requirements, so on and so forth. So we can dig more into that through the course of the conversation.
Yeah, absolutely. Miles, maybe if you want to jump in here, and you are a lender, so if you could share your perspective.
Yeah, so I mean, we've seen a significant increase in demand, particularly in the last 6 months. I think as the strategies have shifted for family offices, for corporate treasurers, they started to buy into the whole MicroStrategy piece and started to buy, for example, BTC or bring BTC onto their balance sheet. They're then looking for ways on how they can leverage that, right? Because as we know, there's no inherent yield in BTC in particular. So yeah, we've seen a significant jump. We've grown our lending book in the last 12 months alone by 140%. And we at the moment are, struggling ourselves to keep up with the demand that's coming in. I think echoes kind of what Chris was talking about.
Absolutely. Maybe Chris, just to jump back on what you were saying. So, folks might have seen that Cantor Fitzgerald has started a lending program where they're unlocking 2 billion of capital to loan against Bitcoin.
Yep.
And NYDIG is also facilitating a lot of lending in the US. How do you think that kind of capital getting unlocked affects the market? Obviously on rates, but otherwise as well.
Look, I think it's a good start, but these are they're kind of like they're much smaller companies. The massive pools of capital sit within the GSIBs or the bank holding companies, and they're still subject to Basel III capital requirements, which in practical terms means that they have to hold $1 for every dollar, $1 in reserve for every dollar of a stable coin they hold, let alone, and that would be the same. That would be the same for Bitcoin as well. And so even if you went to them and said, "Hey, listen, here's $100 million USDC, can I have a $100 million loan?" It's just the capital requirements on their side just blow the economics totally out of the water. And so we've started to see some niche players who aren't subject to these Basel III capital requirements come into the space. The likes of Cantor, it's an investment bank, but it's not a bank holding company. NYDIG, similar situation. So I think that there's definitely movement there. Look, there's a tightrope that you can walk. Like if you're a Group 1B asset, you're then subject to normal capital requirements as if it's a normal security or a normal bank deposit. So far, no stable, no crypto asset. So not even like a USDC has been given access or been recognized as a Group 1B asset. So right now it's pretty much closed for the largest pools of capital that exist in the banking space.
And what are these other pools of capital that might, be the precursors to that largest pool of capital outside of the ones we're already seeing?
Yeah, look, I think the private credit is massive. We've seen private public credit spreads collapse to the lowest levels that they've been in a while. So look, there's definitely people still chasing yield out there, and look, the yield that you can get for some crypto collateralized loans is pretty decent. So I think that you will start to pull those in, but I think there's there's still a fair amount of education and a familiarity with the technology and safety and so on and so forth, which is when people like Anush would step in.
For sure. Maybe Anush, if you want to share, what's your sort of state, what's your vision of the lending ecosystem right now?
Yeah, I mean, right now, to both Chris and Miles' point, it's expanded quite rapidly. There's obviously still quite a bit of fragmentation, right? And when I say fragmentation, what I really mean there is, as you think about DeFi lending pools, DeFi protocols, as you think about more centralized lenders as well, right? Starting to get more and more involved in the game, having more appetite to do so. One of the biggest challenges I do see, though, is that all of this is happening at a fairly, I'd say, smaller to moderate scale, right? If we think about putting ourselves in the tri-party servicing position, our biggest sticking point is getting the lenders comfortable with liquidation, right? And when that happens at an amount that's not 10 million, it's not 100 million, it's 500 mil, then what, right? How are you going to essentially plug into those sources of liquidity and be able to work with a variety of liquidation agents in order to actually facilitate that? And that's where I think the market still has a ways to mature, right? Everything at the moment, or the large majority, is still very much OTC bilateral trades, right? And this is where we need to, I think, continuously push, work together, and just try to understand at the end of the day as well, avoid ourselves getting back into a Three Arrows Genesis BlockFi situation where suddenly the concentration in one place unwinds a Lego effect in others.
Kevin?
Yeah, I think actually that it's a very good transition when you come back to your initial question on what changed. Well, the headline is that lenders have stopped blowing up, and that's quite a big change, right? And you just mentioned some of those instances. The reason for it is, I think that as a market, we're starting to stop to pretend that just because you're new, you're better. And what we had in the past when it comes to lending was actually the worst of both worlds. We had fully centralized players with all the control and no oversight whatsoever. And that's basically what led to all the issues that we've had in the previous cycles. Now this has somewhat matured, and it's not, we're not there yet, but we're on the right path where we're starting to have more and more actual oversight of the centralized players. But even more interestingly, we're actually starting to build something better with what is now available on DeFi, where you have this kind of baked-in transparency. Of course, it's not perfect yet, and we've had many debates over the day around what is still missing, in terms of regulatory compliance, for example, for DeFi to really be able to, become as big as I personally believe it should be. But I think still we are seeing this maturing on the market, and that has made a tremendous change. And where I think we're still not at reach the high there was in terms of lending compared to previous cycle, but we are getting there. And more interestingly, we're seeing a really innovative solution now that, are going to dramatically increase the size of the market.
Yeah, maybe just jumping into that CeFi lending versus DeFi lending. Maybe if you were to give sort of a summary of what are the material benefits of lending happening on chain rather than in CeFi pools, and who are the players who can access it now, and what has to change for new players to be able to access that DeFi lending infrastructure? Chris, maybe if you want to start with this.
Yeah, look, I think a lot of it is like familiarity with the technology. There's also yeah, I mean, the vast majority of it is familiarity with the technology, in fairness. Like, I think it's getting comfortable with, effectively finance on crypto rails. That's going to be, by far and away the biggest hurdle, I would say. But look, I mean, I think that, what we're starting to see, last month we saw, DEX volumes hit 31% of total marketplace-wide volumes. It was a new all-time high. The interesting thing for us, like we're fully regulated, always have been. We're regulated. We've purposefully gone out and got the toughest licenses from the hardest regulators in the world. So we didn't go to Malta, we went to Germany. You go to Germany not because it's easy, but because it's hard. We're regulated in Hong Kong, we're regulated in Gibraltar. Like, we are fairly sure that we're very close to getting our BIT license in New York, although I've been saying we've been getting it next month for about 3 months now. But this time I really am sure. So so one of the things that we see as a highly regulated organization, look, if this asset class is really going to 10x from where it is now, and I think that everybody sat here, we wouldn't be sat in this room if we didn't think that there was significant growth left to come. Our supposition has always been, when that happens, where is that growth going to occur? where's the trading volume going to occur? Is it all going to be, on off-chain, is it all going to be on, unregulated offshore exchanges, or is it all going to be onshore? And I think that, trivially for the next 2 to 5 years, it's going to be onshore. Like, banks, insurance companies, pension funds, they're going to demand a level of oversight, especially with regard to an asset like this that has very unique security characteristics around it. And so, but like looking further forward out, like where are we in kind of like 5 years, 15 years? I think it's a lot more unclear. Like, I think that what some of the early experimentation in DeFi has shown us is that, the simplicity of use, the ease of use, the global nature, you can source liquidity from all over the world in one place, that has a lot of benefits. Now, I would say that it's still, we're still kind of figuring out what ultimate models should be, and like how much, we've got kind of like permission pools and unpermissioned pools, and what is the final steady state of really putting finance at scale on chain. But I think the early indications are very positive.
Miles, maybe if you want to comment on this.
Yeah, from our perspective, yeah, I mean, Chris touched on being a regulated entity. We're a regulated bank, which is, kind of the highest level of regulation you can get in most countries. So we are under intense scrutiny, every move from our regulators, and rightly so. We're held to account on that basis. We are starting to see the institutionalization of DeFi. So CeFi is taking the best bits from DeFi and putting that into traditional financial systems. That might not be, if you're a DeFi purist, that might not be where your heart lies, but that is what's happening.
What does that mean? Do you mind expanding on that?
So banks, for example, for us, we're able to take tokenized collateral, right, which most banks cannot do today, right? They might have it in a sandbox. We have it live in production and can issue a loan tomorrow based on tokenized collateral. We take most cryptos, not just BTC and ETH. We take altcoins. Again, most lenders, regulated banks cannot do that today. We also utilize smart contracts to make the processes more efficient, to remove intermediaries, the very essence of blockchain as a technology in use case for financial services. And we also start to look at on-chain settlement. On-chain settlement becomes a bit more difficult because of the geographical spread and where our clients are based and whether something will stand up in a court of law. But we're starting to experiment with on-chain settlement. Yeah, but we are a bank, so we're not the essence of DeFi. Does that answer?
Yeah. Perfect.
And then to Anush's point around, the liquidation side, and actually, sorry, Chris, again, what you said about getting people comfortable. We speak to other TradFi organization, tier one banks, and that 1 a.m. on a Saturday margin call, that liquidation in the crypto market, which just we don't see in the trad markets or nowhere near to the extent, and because of also the element of volatility that exists in crypto. TradFi organizations are far from being comfortable with that situation, with all the processes that sit behind that. At the moment, unless we speed up, we're probably still years away from that becoming the norm within the majority of most banks.
Chris, you mentioned that familiarity is a big challenge here, and also the large pools of capital cannot access this, cannot get involved. That creates like room for regulated entities who can act as that intermediary on the front end with DeFi on the back end. People are calling it the DeFi mullet. That's the term on the street.
I like that.
Have you thought about that, Miles? Like accessing the DeFi pools on the back end and then using your position as a regulated entity on the front end to, maybe unlock use cases or build that familiarity, because it's not a 0 to 1. Maybe there's these sort of stages in between. How do you think about that?
Yeah, I mean, this is something that me and my team are looking at constantly. How can we tap into that? We see ourselves as an innovator pushing the other banks forward. So we want to be in that mix and driving the industry into that region. The challenges for us remain with permissionless versus permissioned, with identity. We all, familiar, most of us in this room are in financial services, very familiar with our stringent KYC, KYB rules. So we need to get to a place where we can do that, where the regulators are comfortable. What we've seen with like Aave back in 2021, that clearly hasn't worked. That setup has not met the expectations that the industry thought it would back in 3 or 4 years ago. So something clearly needs to change. We're constantly experimenting. Yeah.
Kevin, how do you see this space?
Yeah, actually, I think that what you described, so having kind of this this banking mullet, it's a great term, by the way. But so with a bank that remains kind of the link between the technology and what you can do with it and the clients, I think it's really is going to be a great accelerator of mainstream adoption. I don't see why you need to reinvent the wheel every time, right? And so what I personally found exciting, like 7, 8, 9 years ago when I started to be involved in digital assets, is the optionality. It's great to have a way to potentially exchange value without going through an intermediary. But the fact that you have that option doesn't mean that it has to be the only choice for everybody all the time. And there are lots of people that are already, onboarded, most of them with existing institutions, and there's no reason to try to re-onboard them, with something completely new. If we can just upgrade what they currently do with a better backend, great. That's an amazing intermediary step where you actually save a lot in terms of time and go to market costs, and then eventually this creates the type of familiarity that Chris was mentioning is currently lacking, and then potentially allows them to do it themselves without the intermediary if they so desire, if they are in a situation where actually doing it themselves adds value versus doing it with the intermediary they currently know and trust. So I do believe it's not only an intermediary step. I think it's going to be half of the market, basically. Saying that it's intermediary would imply that we would eventually be in a place where there's no intermediaries whatsoever and everybody's doing everything themselves on DeFi. I think that's never going to happen, just because there are many situations where you're very happy to trust a third party and to be able to offload some of your risk to them and pay a cost for that. And that's definitely going to remain.
Yeah, if someone did a count or tally of how many times someone said that everyone on this stage has said stablecoin since the morning, it'd be a very high tally. And in that, it seems like there is this idea that maybe banks will have to find a new role in this new economic system. And maybe this would be part of that new role. And especially, this is kind of really sort of thinking out, but it would have to, we've got lots of steps to make in the meantime around, Basel III. I'm not very familiar with myself, but it seems like, well, I mean, if that's in the way, there's a very, very long way to go to even get to the point where banks sort of take on this role. But if there's no revenue on the other side, these are the kind of things that maybe they would want to push for.
Is it really a new role?
Sorry?
Is it really a new role? Personally, I don't think it is. I think it's just kind of being able to outsource what the back office that they had to build before, outsource that to something that is a decentralized network. But the role itself, which is to provide trust and to provide financing solutions to clients, that remains.
Indeed. A new role in maybe digital assets. Okay, Miles, could you tell us a bit about how do you approach risk management when making these loans? And also, who are the borrowers? What are these use cases of the folks who are, well, yeah. But yeah, maybe Miles, we start with you and then we go to Kevin.
Yeah, sure. So we only serve professional investors, so high net worth individuals and corporates. So we don't touch the retail side. I think that's an important point to make. Typical use cases for us are akin to traditional Lombard lending. So where our clients are looking to access liquidity to reinvest those funds into other purposes. So that could be traditional securities, even more crypto, altcoins if they want to diversify their crypto strategy. That could be real estate. That could be that they made their wealth as a crypto native. They became a crypto millionaire maybe in the last cycle. They wanted to buy property. They were turned away by traditional banks. So we're able to do an assessment. We've built that up over the last 6 years. I mean, there's no kind of real, I can't say that we kind of have reinvented anything. I mean, to the point, it's, these are core lending and credit risk principles that have existed in banking for decades now. But it's understanding and having the knowledge and the right balance between the TradFi world and crypto. It's not just around the initial assessment. All of the coins that we support for collateral purpose, we have ongoing monitoring, we have on-chain event monitoring, we have a whole team that sits behind that brings in the different skills needed to do a proper risk assessment, not just on the credit side itself. We also see, I mentioned earlier, I touched on corporate treasurers. That's a growing area we're seeing significant demand for. Corporate treasurers that are bringing crypto onto their balance sheet for the first time, and then trying to understand how they can generate a return from that holding.
Anush, could you speak to what are the key points that an institution should think about, a business should think about when thinking about the risk side of setting up a lending business? Could you share your thoughts on that?
Yeah, absolutely. I think one of the most important things as well, just thinking about centralized lenders getting involved in this, is just first of all establishing what kind of parameters need to be right in order to make said loan worthwhile, right? If you think about the incredibly wide ranges that exist today in terms of amount of collateral that needs to be held, the LTV ratios, liquidation thresholds. At the moment, again, I would say obviously the yield is good for it, but it's still suboptimal in terms of the structure and arrangements of those. Miles was speaking earlier as well, just in terms of the monitoring of that collateral, right? We're not in a Monday to Friday 9 to 5 world anymore, where settlement T+1, T+2. We're talking about real time, live margin calls happening at 3 a.m. It's all quite a fine line, I would say, in terms of how much trust do you place in more crypto native entities, obviously being regulated like ourselves? How much transparency is there on chain versus what's done on subledgers? All of these movements that are happening 24/7, that equates to gas costs, right? Transaction fees on chain. There's no right or wrong answer, I would say. Right now, all of us are trying to find the optimal way of taking what is on one chain, what is on another chain, making that interoperable, making that transparent at the same time, thinking about what should be on chain, what should be off chain. And at the end of the day, I do feel like these are all of the questions that we need to dig into a little bit more deeply in order to say, yes, we've reached the state of, I wouldn't even say nirvana, but we've reached a state where things are standardized and actually this is super repeatable and worthwhile.
We reach a state where things continue to not blow up. Kevin, what in your view is required for this state of things not blowing up to continue? What's required for a very healthy lending ecosystem to thrive in digital assets?
But I think you need to learn from what already exists and only replace it if you can actually make it better. And so I think that, you know, the same was saying is I don't think everything has to be decentralized. I think it's better to not have to be centralized either, but you just need to make sure that when you go from one to the other, you're not, you know, leaving some benefits on the way. And I think we are, you know, going in that direction. I think that the increased clarity on the regulatory side is definitely participating into that. And so I think it's just a continuation on what we see already. And I guess to some extent have somewhat of a continuing that education and that will to explore, you know, from existing large players in fully centralized market to discover what is possible once you take some of that, you know, centralized friction away. I think that's something that's going to help to continue the acceleration. But I mean, as you say, the word stablecoin has been said a lot, but I think it's very positive because it's the first time that you actually have users. So this is what creates more and more interest and what, you know, will allow to accelerate the understanding that we need for this technology to actually serve a purpose rather than just be a big casino.
Absolutely. Chris, any thoughts on this?
Not really.
Okay, well, let's jump into tokenization then. Okay, so everyone's tokenizing funds, they're tokenizing private equity, they're tokenizing bonds. One of the key sort of value propositions in tokenization is, okay, well, you can then use that asset and then create, you know, a lending market against it, using these assets as collateral. In your vision of, you know, how the lending market will grow, how do you feel this tokenization is going to play a role? Do you feel, and how big do you think, what sort of size do you think this market could grow to, or do you feel like this is the killer use case for these tokenized assets?
I think the first real proven use case of tokenized assets we've already discussed, stablecoins. Like I think that's like broken out, and you know we've talked about that already. But you know that's ready for prime time and is again, you know, hundreds of billions in AUM, going to grow very quickly, I think, and we're starting to see and look, trillions of dollars settling on a, you know, on a monthly basis now. So that's kind of like a foregone conclusion. I think the next interesting, I kind of think of the arc of like digital assets as being, you know, Bitcoin is, I think, proven itself as on its way to realizing its full terminal value as a digital monetary commodity. And I think that's a foregone conclusion. I'd say next in line is kind of is stablecoins, just from where they are and the sort of corporate use cases that we're starting to see, not only in terms of you know, the predominant rails upon which crypto is traded and a movement of trading working capital, but really kind of like we're starting to see real world use case, just again cross-border trade settlement and so on and so forth. You know, I think, you know, beyond that, the next kind of like interesting thing for me is, you know, more in the kind of tokenized collateral space, we're starting to see, I mean, you know, you look at the total AUMs at the minute, they're still pretty tiny. It's clunky. It's all primary issuance. There's not a lot in the way of secondary marketplaces because all these things are securities. And so, you know, you sort of fall into different regulatory, into different regulatory bands. And, you know, the traditional securities exchanges don't support these things yet. But I think in terms of like, if you look at, you know, banks and, you know, the amount of capital that they have to tie up against forward liabilities is just enormous. And if you can speed that up by having faster settlement, you know, we've gone from T2 to T1 in the US. If you can get to T0 and you can net that off and you can do that globally, you know, for investment banks that again have trillions or at least hundreds of billions in unsettled liabilities at any one point, you know, that's a massive cost save. And so I think that's really the next big area that I'm keeping an eye on in terms of development of those types of assets. And then you get into, you know, I think you then really start to open up, you know, the big pools of capital, the banks all involved. I think that you know, we are seeing hundreds of millions of people starting to use stables. The UX is still pretty horrible in crypto. Like it's not great. Like it really isn't. I mean, you do a lot of NFT trading, Kevin. Like I remember like first moving like NFTs around, and it's just like, oh right, it's gone. It's gone. I can't find it anywhere. And it takes you a few hours while your heart is in your stomach. And, you know, this stuff hasn't really got better and materially better over the last, you know, I would say few years. But once you start to get that, you know, those numbers that, you know, hitting hundreds of millions of people using, and you start getting big banks involved, moving, you know, serious value for economically, you know, rational purposes, you know, I think we're really going to start to see a shift.
On an earlier panel, someone mentioned that tokenization is a solution looking for a problem, like a technology looking for a problem. Maybe Mars, have you seen demand of people wanting to use tokenized assets as collateral, and how do you envision that as part of your business going forward?
I probably spend about 60% of my week talking to people that have like the next big idea in tokenization. But I think that I rarely speak to a client that is like, oh yeah, that would really solve a problem that I'm seeing today. And that's on the individual side, but also on the corporate side. You know, I'd agree with the statement on the earlier panel. You know, we took a strategic decision as a bank a couple of years ago to take a slight step back from the tokenization space itself, you know, albeit carving out stablecoins as a slightly different use case within that. But when we look at tokenized traditional securities, we currently do not see the market demand, or that there is enough market demand. I think one thing we just touched on here was liquidity, and on secondary basis, that has been a challenge. And I think that has been it has stopped growth to a certain extent. We now have seen BX Digital Swiss in Switzerland, who have just recently got a license from FINMA to act as a multilateral trading facility for tokenized real world assets. We also see 21X in Europe under the DLT pilot regime with the EU. So it'll be exciting to see what happens in the next 12 months. I personally am not holding my breath, but we'll see.
Maybe I don't know who said that today, but I think it's an incredibly short-sighted point of view. And the reason for it is, if you tokenizing something does not make it inherently interesting. It's just a mean to an end, right? So, of course, if you take step number 1 of 5, then you stop and you say, oh, I haven't reached my destination, walking is useless, then of course you're going to stop, right? But the point is that you tokenize something, that's just step number 1. What is interesting after, what is the utility that you have with the tokenized asset that you did not have before with the traditional one? And that's what we need to not forget. And I think that the industry as a whole has a tendency to believe, oh, this is tokenized, no, it's interesting. No, it's not. If it's a crap asset, you make it a token, it's still a crap asset, it's just a different form, right? What is interesting though is really the utility that you have with those. And this is really the reason why stablecoins have gotten so big. It's not just because it's tokenized dollars, like nobody cares about that. But after 7 years of the industry building around those tokenized dollars and actually putting the rails that make that you can actually use them for many things, then it becomes awesome. And I think it's going to be exactly the same thing, you know, with all other RWAs. It's like we just need to not stop thinking about it the moment they're tokenized, because that's only step 1, and just consider what are the next, 4 or 5 steps that we need to take over the next year, so that, all the pieces of the puzzle are there, so that you can actually use those assets for things that you could not do when they were just, traditional assets versus digital ones.
And borrowing against them being one of the key things?
I mean, it's one of them, definitely. And I think that when you think about how big could it be, I think it can be absolutely gigantic. If you look at the most extreme examples, and again, like what we do on NFTs is, it's kind of funny, right? But can you imagine that I'm currently issuing loans, taking pictures of cats as collateral? And it works. Why not? I personally would not put a tremendous value in a picture of a cat, but it's tradable, it has a market, it has liquidity. You can use that. And of course, that's the most extreme example. But if that's the extreme, imagine everything that you have in between stablecoins and pictures of cats. There's loads of assets that you can use, as collateral, and loads of different types of value that people would put on it. So the size of it can be absolutely gigantic.
Yeah, and one of the key sort of infrastructure points that's playing in here as well is both on the off-chain side and how we can maintain integrity in tracking the collateral and the risk and the LTV and making sure that the loan terms are being met. But also on the on-chain side, I saw last week that Morpho launched V2, where you can, they're allowing permissions to be, and identity permissions to be baked in, and they're allowing, very sort of specific collateral management as well. So it seems like the infrastructure is catching up as well. Okay, any closing thoughts on what gets you excited about the future of the lending market in crypto, or even broadly, if you want to, what are you most excited about in the industry? Kevin, starting with you.
I'm very excited about us stopping to think about what comes next and actually using what we've built for the last 7 years. And I think we're getting there.
Excellent. Miles?
To be honest, when clients no longer come to us saying they've been turned away from every other bank, wanting to borrow against Bitcoin or other crypto, I mean, that would be a fantastic world, because the market size will be much bigger, and that's kind of our goal.
Actually, on that point, where do you source your funding from to make these loans?
So at the moment, the funding is done directly by ourselves. So we don't actually source. We are starting now. We touched on what is changing at the moment. We are starting to see requests for more complex cases, for more, I'd say, traditional like syndication deals. And so we are starting to work with more traditional crypto players. There aren't many TradFi players coming to the table at the moment, but we are starting to work on those syndication deals.
Okay. Anush?
I would very much agree with what Kevin said. I would rather we do more with what we have, right? I would love a world whereby, again, I'm falling into the buzzword trap here with the word interoperability, but I would love if we use various different rails to tokenize a variety of eligible collateral. The eligible collateral is risk assessed. We all have clear understanding of what it represents. Does it have a liquid secondary market or not? What are the issuance criteria, the redemption criteria? Folks should understand just because something is tokenized does not mean that it is settled instantly either, right? I would love all of this to be transparent and for us to just have a simple menu of connected settlement across the board.
I would agree with Kevin. I don't think the world needs another L1 at this point. But what I was going to say actually is I'm looking forward to a time when we, it feels like over the last 7-8 years, we've just been saying, every year it's like the institutions are coming to the point where it's almost a meme. But this time they really are. And it'll be great not to be on panels in 2 years' time talking about which institutions are up to what. That'll be great.
All right. Well, that's it for the panel. Any questions?
Thank you so much. Great panel. I just wanted to ask, in terms of on-chain risk, smart contract risk, how are you thinking about that and what are you doing about it?
Yeah, look, it's there's no right or wrong answer in this. What I can absolutely say for certain is that just because there's a smart contract audit, that does not equal trust. Please know that scope of an audit is important. So that is the one pearl of wisdom that I will just leave. From a functionality perspective, right, the things that we're trying to understand as well is what happens if something goes wrong, right? Like Miles, we're looking to use smart contracts to essentially monitor real time the value of collateral to make notifications to the relevant parties on either side of the borrow and lend, right? To track that. If that goes wrong, the entire thing essentially falls away, right? So what we're looking at is a more holistic overview, right? Making sure that it is indeed operating as expected. There are controls around it.
Yeah, on our end, I mean, we do a lot on chain. We trade a lot on chain, so it's something that we think about a lot. I think the starting point was to understand that the question is not if something is going to go wrong, but when, and then to basically build a risk framework around it. So we've built an entire methodology. I think it's 160 different questions that we have to really understand all the different components of risk in a particular smart contract that we would be interacting with, and then based on the ranking that we have, after this due diligence, is to, have limits in terms of how much capital we're willing to commit and to put at risk on that specific contract. So, and I think that's something that kind of also can be a very interesting collaborative and industry-wide effort to put these frameworks together, because yeah, those risks are there. If you interact with those smart contracts, well, you're taking that risk yourself, you are liable, and so it's important to be able to manage it. Yeah.
Just to add, from a bank perspective, you can imagine we've got, we're looking at this from several different angles, internal and external. We have a cold storage facility that has about 3.5 billion sitting in it right now, which has hardware modules sitting inside. So one thing I would say that we do is we run regular scenario testing, particularly based on real market events. So I won't name, but recent crypto exchange that had issues with smart contracts. We ran several different scenarios. We know that these attacks are becoming more sophisticated. We just need to outpace, those attackers. Yeah.
Cool. Thank you.
Any other questions?
I hope you have your Fitbit on, because.
Welcome. We're going to talk about growing the pie. So how do we onboard the next $1 trillion, not users. My name's Casper. I'm co-founder of Spartan Group. We're a Web3 VC and investment bank based out of Singapore and Hong Kong. And we've got 3 panelists here today to talk about this subject. We're going to go through a lot of interesting points, also tied back to the stablecoin discussion we just had. But before we jump into that, I'll say ladies first and ask Jen to start by introducing herself, and then we can go down the line.
Hi, everyone. I'm Jen, product at Stripe. I actually got a chance to join Stripe 4 years ago, right when we were actually just starting the crypto team. And I think it's been a lot of fun because we've been doing a lot of things in the crypto space, but more recently, I think in the past 9 months, a lot in stablecoins. And I think would be really cool to talk about, is kind of how that intersects with what everyone else here is doing in the RWA space and kind of what the future looks like. So yeah, I basically own our stablecoin payments product, our very new stablecoin financial accounts product, our fiat to crypto on-ramp, and yeah, lots more to come this year.
Hi, everyone. I'm Grace. I work for Citi. Citi is a large global bank. We have over 220,000 employees and clients in around 180 countries. We do have dedicated digital assets professionals for various lines of business. I belong to the markets team, so our working on capital markets use cases for this new technology. We also have digital assets professionals dedicated to our treasury and trade solutions team, our security services business, as well as wealth management. And within capital markets, I work on everything from tokenization of RWA to crypto.
Thank you, everyone. My name is Evgeny. I'm the founder of Re-7 Capital. We're a DeFi asset management firm running about $1 billion across DeFi yield funds, providing on-chain liquidity, making directional investments in tokens and on the venture side, as well as running kind of robo-advisory style risk curation business with DeFi yield infrastructure.
All right, thanks for the intro. So let's kick it off. We just had a great panel on stablecoins, which was focused a lot on stablecoin adoption, especially. What I'm interested in for this panel is, so how do these stablecoins and how do stablecoins tie into RWAs? Because clearly there's, arguably stablecoins are RWAs too, but how does it tie into RWAs? How important are stablecoins for RWA adoption? And how do you see the two kind of interacting going forward? Maybe Jen, you wanna kick this off?
Sure. Actually, when I saw that question on the prep list, I was like, aren't stablecoins RWAs? So I was like, how am I supposed to answer this? But I actually think that the way that we've thought about it, especially in the past year, when we were building our stablecoin financial accounts product that allow any businesses accessible in 101 countries specifically that Stripe doesn't currently operate in today, I think one of the big questions we had to ask ourselves was why? Like, why would someone actually want to hold stablecoins? And I think the way that we came back to it was that it gave people all around the world easy dollar access that I am lucky enough to have already because I live and I'm from the US, but it's not necessarily true around the world. And not only do you get easy dollar access, you also get access to the rails that go along with it. So people can ACH and wire and SEPA in and out of the stablecoin financial account. And how it relates, I think, to your question is that I feel like how I'd plug it in is that for other RWAs that would become popular, it's like easy blank access and its associated rails would basically be how we would think about it, which is like, is this providing something to a new geography, demographic, age group, et cetera, better access to something that someone else actually already sees a lot of benefit from? So you can actually see the things that would be interesting because some group like the US for the US dollar has already experienced like how great and the benefits of that, and basically being able to provide that easy access to folks all around the world or to a different demographic or just a different type of group. So I think that's kind of the high level, which is like we'll see products that will basically end up being able to facilitate and distribute that access to everyone.
Yeah, I agree. I mean, the two will be mutually reinforcing. So stable coins or any other form of tokenized fiat will enable more tokenized non-fiat assets, and vice versa. On the payment side, you can create a lot of value simply by sending payments, right? So tokenized fiat, I feel, could exist on its own and at a lot of value that way. But with respect to non-cash assets, you do need that payment leg to effect a large number of transactions. Otherwise, you end up with more like a barter economy. So yeah.
And yeah, maybe to kind of wrap this point up, stablecoins and RWAs are basically the same things, obviously, with a little nuance. But I think kind of the end game is we're going to have this kind of flat horizontal surface on chain where, a tokenized property, a tokenized stake in a private company, a stablecoin will all exist together and they all become programmable and interchangeable. And that's basically what the long-term game is. And then the only thing I would say is, I think it's also very important for people to be extremely precise and strict on the definition of a stablecoin. Right? Part of the drama we had in the past was you basically had structured products presented as stablecoins, and that's what blew up the market a few years ago. There are people issuing stablecoins backed by real estate. Okay, maybe it's linked to a dollar, but it's a loan, right? It's not really a wrapped treasury. So I think we need to be even more strict about the definitions. Otherwise, non-professional people will lose money.
Yeah, that's actually a very good point. So in terms of tokenized cash or stable coins, there's tokenized deposits, there's deposit tokens, there's tokenized money market funds, and the lines do blur a bit amongst these categories as well. So very good point. Be precise.
And on that point, so we've heard about RWAs or STOs as they started back in the day, right, in kind of 2018 and kind of developed over time. And we've had various tokenized assets, real estate, so forth, and a lot of times they're thought of as kind of, you tokenize them and then people will buy them. So almost more like a B2C product. But how do you see RWA in general? Do you see them as a B2C product? Is it more B2B? Is it B2B to C? And do you see them being almost kind of behind the scenes in terms of used to generate US dollar stablecoin yield versus just being like direct investment objectives themselves? Like, what do you see the role of RWAs as in this general ecosystem? And also to the point about driving adoption, is it going to be related to this question, is going to be directly to consumer distribution, or is it going to be more like, well, I put my USDC in a wallet, I get a 5% yield, and I don't know behind it, but maybe there's a real estate token, there's collateralized auto loans and whatever generating that yield. Evgeny?
I think this question alone can take basically the full day to answer, and we probably won't even get to the full clarity there. So I think historically people have struggled to scale up RWAs because they've been basically selling them to the wrong group of people, right? So people who have been using blockchain so far have mainly been small scale institutions or basically retail people gambling on the blockchain. Why would you want to gamble with something that can only give you 5% a year, where you can play a video game like DeFi experience and get much more? But what I think is changing is we're going to have parallel universes that exist. We'll have the old DeFi world where it's people just experimenting with a lot of things, and then there are going to be partially gated or non-gated chains where banks can finally do something, right? So do I think a random crypto individual should be buying tokenized farm in Africa? Well, probably not. Does it make sense for them to stop gambling on random coins and actually go and put money into tokenized, money market funds or whatever? Yes, absolutely. But I think, and what Robinhood announced yesterday with tokenized shares is making it very clear they're going to be different parts of the blockchain world with different types of RWAs, and they will exist for different purposes, right? So if I'm a customer of, if I'm someone who's using Stripe stablecoin, for example, right, I can go and eventually derive a lot of value from it, and then I'm probably a merchant or as someone else. If I am a bank that trades with Citibank, eventually we'll be able to settle some trades on chain, obviously, but then this will be gated, right? You have to be permissioned and regulated and whatever. So I think there'll be different pockets, and some of them will be B2B, B2B2C, some of them will be B2C. And I think it's very important for people to be kind of very sharp in terms of what is the style of the RWA offering that I'm building, whom is it a fit for, and then that will tell you where it should exist.
Yeah, I think that's an interesting question. I think as a product person, I always think about the end, like the actual user experience and how people, either consumers or businesses, and then the institutions powering them will actually experience the product that they're actually interacting with. So I actually think that for consumers, I don't think it's actually going to be obvious to them. I think they'll understand the benefits, and they'll understand like the app that they're using to interact with something that they're curious about, but they're not actually going, like, maybe a smaller portion of them are going to go into the details. But I think when you hit the mainstream, I think large swaths of consumers wouldn't know. So I was actually doing some research on like LATAM. So we're looking at like different fintech companies in Latin America and kind of looking at the top ones that actually serve consumers. And then you like look at the list and you're like, oh, this is interesting. And then you like look at each of those companies, and like 80% of them are actually just like stablecoin fintech apps. So I think you'll see like a merge in the middle where like right now, I think a lot of people have thought about fintech apps as kind of what we're already familiar with, things that have started in fiat. But I think you'll see both merge. So you have crypto native apps and fintech apps have the same features. So when you have apps that have the same features, are they fintech apps or are they crypto native apps, or a little bit of both? Or does it really matter? I think for the consumer, it doesn't really matter. So as an example, like very concrete example of this, in our stablecoin financial accounts product, we actually were worried about businesses not really understand like that they're holding USDC or USDB or like what is actually in it. So we did a bunch of like user research stuff, and we decided to go with digital dollars for now to see what happens, do some more. But I think the idea is like we'll wrap into something that actually matters to them. And like I said earlier, that product specifically was for easy dollar access. So that naming made sense there. But I think if you look at the user experience, the consumer or even like the business acting as a consumer experience will kind of hide the details unless they're really passionate about it. Then they could go in the info button, do the research, and actually see what underlies everything, but make it easy for people basically.
Yeah, I would hope that as the technology in the industry develops, that there is more transparency, so those details are easier to access, because I think that's a really important benefit that this technology allows, and that we should try to realize. But yeah, to your original question,
So the last panel of this day is the CFO outlook. So we're here to talk to the CFOs at different companies to see how they're thinking about things, especially over the last year where we've seen a lot more regulations. We've seen a lot more support from governments worldwide in the space, and there's a lot evolving. So to see what they're thinking about and moving forward. So I'll let everyone introduce themselves. I'm Jeff Runlett, Head of Accounting Strategy at Cryptio. I've been here for about 3 years.
Hi, thank you all for hanging in there. It's been a good day. We're the last ones up. I'm Philip Prince. I'm the CFO at BCB. I've been CFO for almost 5 years. My background was over 21 years at BDO. So all those accountants out there, yes. BCB Group, we like to aim to bank the entire crypto industry. And what do we mean by bank? Provide payments on and off ramps, and fundamentally get everyone using our Blink network. So that's a 24/7, 365 instant payment, instant settlement, fee-free network. About 75% of our volumes, which are significant, are on Blink at the moment. So the more of you on Blink, the cheaper and easier money moves.
This could be one of the greatest opportunities you're ever going to see. But for those who ignore this warning, they will see.
Thank you.
Hi everyone, my name's Mika Thompson. I'm VP of Finance at Yellowcard. We are the leading and licensed stablecoin payments orchestrator for Africa and the emerging world. And prior to Yellowcard, I spent 5 years at BitOasis, one of the leading retail exchanges based out of Dubai, where I lived for 12 years. I've been back now in London for 5 years, and I'm really excited to be here today and looking forward to the discussion with my fellow panelists.
Hi, hello everyone. My name is Massimo Di Placido. I'm the CFO of B2C2 for the last 7 years. Prior to that, I spent some time in Luxembourg in audit at EY, so fellow consulting firm. B2C2, what do we do? So we're one of the most established, largest liquidity provider in the digital asset space. We're servicing institutions globally through various products, namely spot derivatives, market making on exchanges, market making for foundations, and we're doing that mostly electronically. So yeah, thanks for having me, Jeff, and looking forward to it.
Hi everyone, I'm Sarah Bax, Senior Finance Director at blockchain.com. I've started my career in KPMG, so I earned my stripes there in external audit and spent some time working in US capital markets. So I've also come through a very traditional finance path, but I did feel like something was missing. And so I started working in the crypto space a few years ago. My personal journey with crypto started many years before that. And it came down to me trying to send my mom some flowers in South Africa. I was based in the UK, and unfortunately, the bank took a 20% cut. And so here we are. This is exactly where I'm meant to be, you know, a couple years later, working in a space that I truly, wholeheartedly believe in. Blockchain.com has a range of services. So we service the retail side. We have an exchange that offers sell, swap, buy opportunities. We also have a block explorer, and we also have a range of products on the institutional side. So we have an OTC desk, we trade derivatives, and we offer products in terms of staking, lending, and many others. Right.
Thank you. So I want to start off with rapid fire, just hearing from everyone. Starting with you, Sarah. What's been the most surprising change you've seen in the last year of what you're focused on?
So the last 6 to 12 months has been nothing short of turbulent in the markets. We've seen the changes in the US administration. There's been geopolitical risk. There's even been global tariffs. Who would have thought? And when there's so much turbulence in the market, trust is the only currency that the market really cares about. And so from my perspective, I've seen CFOs have to be a lot more hands-on when it comes to financial statement audits. They've had to get involved in conversations with the auditors. They've had to be more involved in terms of working with their teams on complex areas. Being a crypto CFO is not for the faint-hearted, and it definitely doesn't come with the job description, in my opinion. You have to adapt to the needs of the business.
Massimo?
Agreed. I think from my perspective, things we've seen, and maybe not necessarily the last 6 to 12 months, but over the last couple of years, is not only about accounting, reporting, forecasting anymore. There's much more than that. And strategic, technical knowledge about the crypto are becoming paramount for all the finance team that we have at B2C2. Strategic, so we expand geographically. That means, well, what's the legal structure? What is the regulatory footprint? What is the transfer pricing arrangement? What is the local requirements? All of that needs to be very well thought before expanding and supporting the commercial effort into those jurisdictions. Technicals, I guess I have to start learning qualified custodians, self-custodians, what is the disaster recovery process, how do we arrange the tap policies. I'm obviously not running the infrastructure myself, but as CFOs and finance team, we need to be aware on all those components. So I think over the last couple of years, Jeff, that's probably, to me, it's a broadening of the remit of the CFO that's happening.
Well, I don't think the role has changed. The world is an increasingly much more volatile place, and whether that's geopolitical instability or crazy leaders running countries, you know, we've got sudden changes in currency fluctuations, in interest rates, sudden tariffs, you know, risk appetites of banks and lenders. So CFOs really need to be able to see these changes and adapt and pivot to them. Also, interestingly, you know, companies are increasingly and rapidly needing to form their stablecoin strategy. Just last week at Yellowcard, we've announced a super exciting partnership with Visa, who'll be using our crypto infrastructure to manage their treasury operations. With Amazon and Walmart also announcing their plans for a stablecoin to save upwards of $143 billion a year on bank fees and interchange fees. Companies are increasingly realizing that they need to have a stablecoin strategy in order to stay competitive.
Danger of going last, as it's all been said already. So I try to add that along with the increasing speed of change and the uptick in the sentiment over the last 12 months, and particularly since the Trump administration, there's also a sophistication increase across the business. All of you in the crypto industry are getting more sophisticated, because if you weren't, you wouldn't be here. So we need to do the same. So what might have been acceptable 2 or 3 years ago in terms of a statement or an interaction with a customer or an auditor or a banking partner is no longer good enough. So the level of professionalism and some of the older digital assets, crypto habits, which were almost liked previously, are no longer acceptable. So it's professionalism, doing it properly, doing it on time, and making sure that when you talk to particularly regulators and auditors, we look like TradFi. We haven't wanted to be TradFi in the past, but just in that domain, we need to look a little bit more like what has become normalized in terms of all our stakeholders. So I think going forward, we need to try to balance that with retaining the interesting edge that digital assets is going to bring. It just isn't quite here yet, as we've heard all day today.
So one of the easiest ways for growth is market expansion. Massimo, you touched on it, but a lot of the weight falls on the shoulders of the CFO to make sure, you know, that goes right. Now, Sarah, I know you guys are starting to expand into Africa. So how do you assess that? How do you assess the risk versus reward? How do you assess, you know, maybe the regulatory uncertainty in the area, or and how do you support that as you look to expand into that region?
Great question, Jeff. There's a huge potential for growth in Africa. Let's frame the opportunity we're talking about. Bridgewater recently announced that they're expecting to see a huge demographic shift in sub-Saharan Africa. They're expecting to see by 2050 growth in the region from 10% to 25% of the global working age population. 25% of the global working age population in Africa. And so our approach at blockchain.com has been to enter markets early and to work alongside regulators in terms of building out progressive frameworks. Naturally, timing of entering a market is very important, but that does have to be combined with being adequately prepared to enter that market. And from that perspective, we have seen successful expansion into Africa. Another one of our strengths has been having presence on the ground in the region. We have an amazing team out there, and they are aware of regulatory challenges in the space. They've been helping us stay connected with regulators. They've been helping us understand what the thinking is behind regulations as they are being developed. And having that sort of understanding has put us in a better position to actually be prepared and to stay compliant. We've also had the benefit of working with regulators in other more established markets, And so we're able to bring that experience into the room when we're having these conversations. So, yes, Jeff, absolutely, it can be done. You can stay ahead of the curve. It's just about getting involved in those conversations early on and working with regulators as they are still building and shaping these frameworks.
And Mika, you're in 20 plus countries in Africa. So what are your thoughts here and how have you navigated that market?
Yeah, so thanks, Jeff. Launching in your first country is obviously very different to launching in your 20th. Africa has some of the most challenging markets globally. And Yellow Card, as well as engaging positively with regulators and public policy advocacy, we look at the market opportunity. Is it worth it? The banking and payments landscape. How quickly can you move capital around? That's really important. Of course, the regulatory landscape. What licenses, if they even exist, are required? If central banks and financial markets regulators are clearly anti-crypto, then of course it's a no-go. But you need to keep your eye on the upcoming changes. Perhaps there might be an upcoming change in legislation that's going to shift attitudes towards crypto, or even a change in a ruling party where you're going to see like a 180 shift in that outlook and adoption. So also needing to keep an eye on the upcoming tax regulations. So for example, in Kenya last year, they launched a digital asset tax where 3% of a crypto transaction on the traded volume is supposed to be withheld on the settlement of the transaction. And this would be recoverable against your corporate income tax filing at the end of the year. The trouble is, no one's making a 3% margin on these transactions. So this would effectively kill the Kenyan fintech industry. And the impracticality of this tax was evidenced in the 0 tax receipts collected in the 9 months since the inception of this. So Yellow Card has been engaging with the finance ministry, with the revenue authority, and last week it was announced that this law is being changed. So instead of a 3% tax on margins, sorry, 3% tax on traded volumes, it is now a 1.5% levy on fees, which is quite a U-turn and a great result for us. So it just goes to show that you really need people on the ground, good intel, that people that know what's going on and how things work.
Thank you. And so Massimo, your company thrives off of providing liquidity in highly volatile markets. As a CFO and providing like FP&A, I could imagine that's extremely challenging as well. How do you ensure you provide clarity as the markets are constantly turning up and down and changing all around? Is it something where it's maybe more frequent, or how do you think about that?
So volatility is there. We love it, and the reason why we love it, which is slightly contradictory with the FP&A conversation, but as a business, that's how we make money. We need volatility. So it's all about building operational resilience in your own system that then you can absorb and you can deal with the volatility. We're not seeking to avoid volatility. From a client perspective, well, I guess from the business or on the client orientation, we want to make sure that we have a live streams of your client balances positioning, so you can make sure margin calls and all liquidations are made timely. Similarly on the exchanges, when we are transacting directly ourselves on exchange, you want to have live position like alerting system, margin calls, automation to avoid at all cost liquidation. So that's how we deal with volatility from a pure business perspective. Now, when it comes to FP&A, obviously it's much harder. It's much harder. So it's an educational process that you have to do with shareholders, with stakeholders, with various audience reading those financials, because yes, the revenue is hard. It's really hard to project revenues, and obviously you can make as many assumptions as you want. We ultimately, depending on the market and depending on the performance of the market, obviously what we can control and what we should control is the cost. So obviously you have different approach, but the approach at least on our side is obviously excluding the out of the ordinary performance and maintaining a bit more of a safe approach. So we've been around for 7 years, 10 years the company, 7 years since I joined. We've been very much safe in terms of spending, in terms of hiring, in terms of marketing. We've never let go 5-10% of the float, even when things were going not so great. So I don't think there's a miracle solution. There's different approach, different CFOs. Ours was always to be more on the safe side and I guess averaging out of the more slow month, I would say.
Sure. So let's take a bit of a pivot. We've seen a lot of activity in the IPO space. Circle, we talked about that a little bit before, but a huge success. And you can only imagine that the success of that is going to drive many other companies to start thinking about this. So, Philip, you've helped take companies public before. Given all the volatility and all the uncertainty and just really the new companies out there and maybe not being ready, but being more ambitious. How do you think about everything when a company is, ambitious to go public?
That's a really great question, and I'll try to not disappear into 21 years of experience at BDO and try and make it specific. So you're right, the US market is on the up. The Trump administration change and the uptick in digital assets interest plus the Circle IPO is clearly a huge indicator. And I'd certainly back the US market in terms of IPOs compared to the UK market, European markets, much as I'd like the London Stock Exchange to have some great big digital asset player. Realistically, anyone looking at it has to probably put the US at the top. So US is your target. So you therefore need to plan what's the reasonable time frame. And if it's under 24 months, it's probably wrong. So you should be thinking 2 to 3 years out. You should be thinking about what's going to make an IPO successful, and you should be working on what you can control. Number one, revenue growth. The Americans love revenue growth. Please have lots of revenue growth. So it's a flippant point, but make sure that your business doesn't forget that revenue growth is the number one and spend all of its time doing admin. Preparing for an IPO is admin. Growing the revenue, building a fantastic business is the most important. So have as many of your people doing what they were doing yesterday before you told them you're going for an IPO. That said, then have a dedicated core team looking at IPO planning, all the legals, all the accounting, all the contract work, all of the tax work. It's been mentioned before, transfer pricing, cross-border activity. Get that done. Try to engage external expertise where you need it, but don't outsource all of it. You need to have team and expertise internally to try to get all of that right. The other thing to say about an IPO is you don't know when the market's going to be good. So you want to try to get ready as soon as possible and stay ready. That's really not easy to do because you want to be ready to go when your bankers, because they'll come to you. They'll have scouted you out already and they'll see that you're an interesting IPO prospect. And they'll come to you when the market's ready and they say, okay, are you ready? Let's go for an accelerated IPO over the next 6 months. And it'd be really horrible to say, we need a year because you'll miss the boat. And the other thing I'd say about IPOs is, even if you don't think an IPO is your exit, if you think you're ready-made M&A, ready-made for M&A, someone to buy you up, preparing for an IPO is about the best practice. It's about the best way to make sure everything is ready for whatever comes along. A great marketing tactic is to launch your IPO in the hope that you flush out any M&A activity because you're public, you're visible. You're not public yet, but you're visible in the market. The bankers are lending some credibility. Therefore, people can see that you've been looked at, the diligence has been done. Then they'll swoop in and they will seek to outbid whatever the IPO market might do. So there's a lot there, but it's a really good strategic way of thinking about what your exit might look like. But just don't put too much resource in it because you've got to keep that top line growing.
What would you say are maybe some of the things that are often overlooked that are extremely important that maybe get?
Step into options education with confidence. At the Options Industry Council, we want you to know your options.
Get a last minute attention to, when getting IPO ready?
Well, we're accountants, so I'd say it's the accounting. In the US, it's going to be US GAAP. If we're not reporting under US GAAP, IFRS or UK GAAP, don't underestimate how hard, not necessarily the journal differences are going to be, but the disclosure. A US IPO document looks very different to a set of UK stats, looks very different to a UK admission document. So yes, the advisors will say, well, this is what it's going to look like. This is what you're going to have to provide us. But going from one gap to another and restating for the last 3 years and making sure it's audited is significantly challenging. That's why you need the 24 months, because you're going to want 1 or 2 months in the past already done, and then you can have the third one done just before the IPO and then go. But the same applies in the legal side of things, the contract side of things. You need them all to be fully diligenced, and if there are concerns, risks, uncertainties, you've agreed with your lawyers how they're going to be disclosed, and you discussed with the bankers how you're going to handle the impact that they might have on valuation.
And you mentioned the different regions. Is there any specific region that you think is the best to IPO in, being APAC, Europe, Americas?
I think at the moment the overlap of crypto and the markets and the depth of market has got to be the US. So if you're particularly big, you can look at a IPO in 2 locations, a primary listing, a secondary listing. We've just seen Wise announce it's moving from the UK to New York. It's going to maintain a secondary listing here, and that's purely based on valuation. They're big enough, and I suspect their value might 30, 40, 50, 60% when they move, and they will be able to keep a listing in both places. You have to have scale for that. So you need to take the advice, look at the pros and cons, look at whether you want to relocate to the States, if that's what it's going to be, and then decide and move forward.
Thanks. And Sarah, there's rumors of your company being IPO ready. And sticking on the different region topic, how do you make sure that across the different regions that you're adhering to at least the specific standards, or maybe having the same high level standard? How do you approach that to make sure every region is ready to go?
So one of the challenges we faced in the past is having consistency across policies, processes, and controls, especially when these need to be fit for purpose in standalone regions where there are varying local regulations. You have to balance that with the needs of the group at the same time. And so one example that's been challenging for us is definitely cost basis methodology. And this is what you apply when you revalue your digital assets. We've had to rethink our approach and adapt that so that we are balancing the needs of standalone audits as well as our group audit. And that's taken a bit of time, careful planning internally, as well as work from the broader finance team to make sure that that works as it should. When it comes to audit readiness, there's a few things to consider here. From my perspective, what's worked well for me in the past is engaging with your auditors really early on in the process, having open conversations about areas of concern, making sure that you're flagging those in advance so that you can work together to find practical solutions that will help you get the correct audit outcomes. Having a strong, open, collaborative relationship with your auditors is really key to having successful audit outcomes. Coming back to IPO, Philip, you've mentioned, a lot to consider there. I think the path to an IPO is definitely a journey. A lot of times it's viewed as a finance-only project, but I think that is a misconception. To IPO, you need every employee in that organization to be working towards that same goal. And generally what I've seen is that there is a huge cultural shift required in many entities from being private to going public. And so you need leadership to drive that focus of the entire organization. When it comes to blockchain.com, well, you'll know when we're ready to pull the trigger when you hear us ringing the bell.
And what have been some of the more operational challenges that you've dealt with in mentally preparing yourself or the company to get there?
I definitely say data flows. We're an exchange. We have big data to deal with. And so making sure that you are controlling the processing of that data for every single hop through your systems, be that internal or external, has been challenging. You need more than just accountants in the room. You need to have data science. You need to have your FinOps team, middle office team as part of those conversations as well. So I'll say that's something that I've actually learned a lot by going through that process at Blockchain.